Most investors are thinking that 2026 will be decided by interest rate or inflation, but that's not what's quietly shaping the markets right now. Two geopolitical moves in Venezuela and Greenland are already changing where capital is flowing, thanks to Mr. Trump. And if you're watching the wrong signals, you risk positioning your portfolio after the opportunity has already passed. In this video, I'll show you why the energy and power sectors are the first sectors to watch and how a risk-aware investor can identify which parts of the sector will benefit the most and where the real risk still sits, so that you as smart investors can potentially profit from these geopolitical moves. Also, this is part 1 of an 8-part series where I will cover different sectors and specific stocks within those sectors who are actually positioned to win in this very uncertain macroeconomic environment. So please watch this space. Welcome back to Wages to Wealth. I'm Hitender, and by day I work in credit risk at a major retail bank. And my job is to think about what can go wrong and make sure there's enough protection when it actually does. That same mindset shapes how I invest my own money. Not predictions, not hype, but understanding how macro risks quietly change the odds. So let's start with the macroeconomic setup and why the energy and power sector is positioned to win here. In early 2026, renewed US involvement in Venezuela put global oil supply back into focus. Venezuela holds some of the world's largest oil reserves, so any shift there will impact supply. But here's the key point most investors are missing. Uncertainty in fossil fuels doesn't slow the energy transition, it actually accelerates it. When reliability is questioned, governments and businesses prioritize resilience and control. That is why capital is flowing towards solar, nuclear, and grid-resistant power, not as ideology, but as policy-driven necessity. Now let's look at a few names investors constantly track through a risk-aware lens and why these deserve a spot on your watch list. The first one is First Solar, ticker symbol FSLR. What's good about this company? First Solar actually benefits from very strong US policy support and a differentiated manufacturing process that avoids Chinese supply dependency. This stock has returned about 47% over the last 12 months and it has much higher price targets by analysts. Some of the key risk is the fact that revenue is heavily tied up to government incentives, meaning policy shifts or delays can impact project pipelines. So please keep this in mind. Next is Enphase Energy, ticker symbol ENPH. What's good about this one? It actually sits at the heart of distributed energy systems and it benefits from residential solar adoption and grid decentralization. This company has had a rough last 12 months with the stock down almost 39%. However, Trump's focus on energy provides favorable condition for this stock, especially in light of recent upgrades from Citi and Goldman Sachs. A key risk is the fact that demand can be cyclical and higher interest rates or slower housing activity can pressure near-time sales, so keep that in mind. The next one is Oklo, ticker symbol OLKO. What's good about this company? It actually offers next-generation nuclear solution that addresses the need for reliable, carbon-free and dispatchable power, a key gap renewables can't fill alone. Oklo has had an explosive last 12 months. It's up almost 180% with higher price targets by analysts. A key risk here is that this is still pre-revenue and it's regulatory dependent business where timelines and approvals remain uncertain. So this is a high risk and potentially high reward play, and position sizing becomes very important in these scenarios. The last stock on this list to watch out for is Next Era Energy, ticker symbol NEE. This is a world leader in renewables with regulated utility cash flows and long-term growth from wind, solar and storage. NEE has performed relatively well. It's up almost 15% over the last 12 months and analyst ratings are higher than the current stock price. The risk is the fact that it's a capital intensive model and it's sensitive to interest rates. So the key takeaway here isn't to pick winners. It's to recognize that the energy security is now a policy priority and not a market cycle. And when policy drives capital, the opportunity often appears even before the headlines come. As always, this is not investment advice. Please do your own due diligence and research and understand the risks before investing your hard-earned money. Energy and power is always the first domino. But once power becomes a strategic concern, the next question governments will ask is very simple. How do we protect it? That's where defense and aerospace will come in. In the next episode, we'll break down why Greenland has pushed defense spending back into focus and which companies sit at the center of that long-term investment theme. If you like this video, please subscribe to the Wages to Wealth channel and turn on notifications so that you're kept up to date when we release new insights. I'm Hitender and let's turn those wages into wealth. Thank you so much for listening. See you in the next one.